Welcome to this explainer. Look, if you're a Singapore dividend investor watching the markets lately, you already know it's been a brutally tough season. We are sitting in this high interest rate environment that has just absolutely battered the REIT sector. Across the board, we're all feeling the sting of rising debt costs and stagnant growth, and frankly, it's led to a lot of widespread market panic. But within this storm, there are always these fascinating anomalies. Today, we're taking a calm cinematic look at one of those exact anomalies, a situation where market sentiment seems completely decoupled from the actual structural reality. And that brings us to the central mystery we're going to unravel today. We are talking about digital core REIT. Data centers are undeniably the absolute hottest real estate sector on the planet right now. I mean, they're fueled by the explosive, unstoppable rise of artificial intelligence and global digitization. So why on earth is a pure-play data center REIT trading at such a massive discount to its actual book value? For us focused dividend investors, this wild disconnect between short-term market panic and long-term structural reality is precisely where the greatest opportunities lie.
All right, let's get into part one, the headline optics, or what we see right on the surface.
Let's kick things off by acknowledging what you see right when you open your brokerage app. When the latest half-year earnings dropped, these were the headline figures staring back at you. Gross revenue came in at $88.6 million, which honestly is a slight dip of 0.4% year over year. And the distribution per unit, or DPU, came in completely flat at 1.80 US cents. Now, if you're a typical yield-focused investor doing a quick scan on a screener, a slight revenue dip and a flat dividend, it probably looks pretty stagnant. It might even feel a bit disappointing when you compare it to the crazy, explosive AI headlines we're reading every single day. It's totally valid to see these numbers and think, okay, where's the growth?
And yet, because the share price has taken a hit, the distribution yield is actually sitting at a rather elevated 7.19%. That's a bump up of 34 basis points. Now, a yield over 7% in a top-tier asset class usually flashes a warning sign that the market is pricing in some significant risk. But as we're about to discover, this optical reality, the flat DPU and that tiny revenue dip, is literally just the tip of the iceberg. The real story is definitely not in the headlines.
So let's move on to part two, under the hood, looking at the operational realities.
To figure out what's really going on here, we have to peel back that surface-level noise and look under the hood. We need to look at the incredibly strategic, calculated moves management is actively making to defend and optimize this portfolio in a tough macro environment. When we dig into that 0.4% revenue dip, there's actually a very specific structural reason for it. The trust had a vacancy at their 8021 Linton Hall facility in Northern Virginia simply because it's currently undergoing a major redevelopment. This is a deliberate, planned upgrade, not some structural failure. But here's what's truly impressive. Look at how management handled that lost income. They actively offset this temporary vacancy with organic portfolio growth. They drove higher cash rental income through contractual rental escalations, they pushed through a massive 25% cash rental reversion on a renewal lease, and they secured significantly higher utility reimbursements. Basically, they took a temporary hole and patched it with permanent organic growth.
But they didn't just stop at managing the properties. They actually went on the offensive with their capital. Get a load of this staggering number, 8 million. That is the exact number of units management proactively repurchased in the open market during just the first half of the year. And this is a brilliant illustration of turning a perceived weakness into a massive strength. Because the stock was trading at such a steep discount, management swooped in and bought back those 8 million units at an average price of just $0.488 US. To put that into perspective, that is roughly a 38% discount to their net asset value. By retiring those shares at that kind of bargain basement price, they essentially manufactured 0.4% of DPU accretion out of thin air. That's just smart, aggressive capital management that goes straight to the bottom line for remaining unit holders.
All right, part three, the AI demand supercycle, or what I like to call the ocean. So we know the internal operations are rock solid and actively managed. But now we've got to zoom out. We need to shift our focus from this single reed bobbing in the water and look at the massive, unstoppable currents of the ocean it's floating in. We are talking about the AI demand supercycle. The numbers coming from global real estate authorities like JLL and CBRE are honestly almost hard to wrap your head around. We're looking at a projected 14% compound annual growth rate for the data center sector all the way through 2030.
Globally, data centers are sitting at a mind-blowing 97% occupancy rate, and over the next 5 years, this explosive growth is going to require up to $3 trillion in total infrastructure investment. I mean, $3 trillion. Fundamental demand isn't just exceeding supply right now, it is completely overwhelming it.
So the real question is, how does this massive macro demand translate to the specific local markets where Digital Core REIT operates? Well, let's look at Northern Virginia, which happens to be exactly where that redevelopment project at Linton Hall is located. According to CBRE, vacancy in Northern Virginia just hit an all-time record low of 0.3%, 0.3%. You would honestly have an easier time finding an empty coffee shop in the CBD right at lunchtime than finding server space in this market right now. This is entirely driven by massive hyperscaler users just rushing to deploy AI infrastructure. The space literally does not exist.
And if we visually map out the global landscape here, you can see exactly where the real power lies. The Americas represent an overwhelming 50% of global data center capacity, and they are heavily leading the charge in growth because of these severe supply constraints. This is incredibly relevant for us because the Americas is exactly where Digital Core REIT operates most heavily. They are positioned right smack at the epicenter of the most supply-constrained, high-demand region on the planet.
Which brings us to part 4, the valuation disconnect. This is where the real opportunity lies.
Okay, so we have a solid balance sheet, we have proactive management, and macro tailwinds that are just historically unprecedented. Bringing this all back to you, the focused Singaporean investor. Just look at the sheer visual contrast in these valuations. At the time of this report, the stock is trading right around 49 cents. The consensus price target from analysts, which is usually the conservative institutional view, is 72 cents. But the adjusted net asset value, meaning the actual tangible real-world value of the real estate this REIT owns, is 77 cents. The market is literally pricing these highly coveted AI-critical assets as if they're distressed strip malls. It's wild. Just to reiterate this and ground our argument in undeniable facts, we pulled this straight from their financial statements. The adjusted NAV and net tangible asset per unit stands firmly at $0.77 US. When you can buy a dollar's worth of prime, mission-critical real estate for just 49 cents, you're looking at a nearly 32% discount to the actual value of the underlying assets. Now, let's look at how this translates to their financial defense. Because, look, sometimes a steep discount implies there's some hidden rot, right? But when we look at the balance sheet, it's an absolute fortress. Their in-service portfolio occupancy actually improved to 97.3%. Their gearing ratio, the amount of debt they're carrying, is sitting at a highly prudent 37.1%, which is perfectly within their target range of 35 to 40%. And perhaps most importantly for the climate we're in today, 70% of their debt is fully hedged against rising interest rates. So there is absolutely no hidden distress here justifying this massive discount.
Let's move into our final section, Part 5, looking to 2027 and the long-term horizon.
As we begin to wrap up this explainer, we really need to shift our perspective. The market right now is completely obsessed with the short-term noise of half-year earnings and the immediate sting of high interest rates. But as focused learners and strategic investors, we have to look toward the long-term wealth-building horizon. According to the World Bank's Global Economic Prospects, this current economic slowdown is temporary. Global growth is actually projected to recover to 2.8% in 2027 and 2028. And what exactly is going to drive that recovery? Well, the World Bank explicitly points to robust artificial intelligence-related investment and broader AI adoption across the entire global economy. This macroeconomic recovery is going to perfectly synchronize with the exact supercycle that Digital Core REIT is built to service.
So I want to leave you with this final provocative thought. We've seen the flat short-term optics, sure, but we've also seen the fortress balance sheet, the highly proactive buybacks, and this multi-trillion-dollar macro wave approaching on the horizon. In an era where data is the new oil, are you willing to overlook a 32% valuation gap for the sake of short-term DPU optics? The smart money's already looking at 2027. Thank you for joining me for this explainer, and keep your focus on the horizon.